how will this stock move compared to the market? Understanding the market. Beta. Beta is the market or systematic risk that a stock has in relation to the market as a whole. To understand beta, it's good to understand how we calculate it. The equation to calculate beta is beta equals the covariance of the return of a stock and the return of the market divided by the variance of the return of the market. Well, what does this mean? Covariance is the direction in which two assets tend to move together. The variance is a spread of data of a single asset. So the covariance of the return on the stock and the return on the market is the direction in which the stock and the market tend to move together, divided by the variance of the market being the spread, or think volatility, of the market as a whole. So a higher covariance or a lower market variance leads to a higher beta. Simply put, beta tells us the amount of risk a single stock carries in comparison to the total risk of the market. As an example, let's look at McDonald's, ticker MCD. As of May 2020, McDonald's had a beta of 0.68. In theory, this means if the market goes up by 1%, then you would expect McDonald's to go up by 0.68%, and the inverse is also true. If the market goes down by 1%, you would expect McDonald's to go down by 0.68%. However, beta is created using historical averages, and therefore, it should be simply thought of as a best guess. In reality, you can never know how much a stock price is going to change. But having a low beta is a good way to help lower your market risk when purchasing any stock. What do I mean by market risk? Well, when you buy a single stock, there's two types of risks associated with it. The market risk, or the risk of the entire market. This could be called the beta. The idiosyncratic risk, or the risk of that single stock. This is the standard deviation or movement of that single stock, also called the sigma. Eliminating idiosyncratic risk can be done through proper diversification or indexing. Eliminating market risk isn't necessarily possible, but can be lowered through asset allocation and picking lower beta stocks. In conclusion, the beta tells you how the stock has moved in correlation with the market in the past. A lower beta is less expected market risk. A higher beta is more expected market risk. That's all for today. If you didn't understand some of the concepts mentioned in this video, make sure to check out my Starting in Stocks series. See you next time.